Thank you for the question. It certainly looks as though inflation is behaving itself relative to what we've seen in recent years. That doesn't mean that we won't get the odd one-off data point, which might point in the different direction, but I would make the point that one data point doesn't make a trend. And so the authorities, the central banks, are certainly moving in the direction where they feel like inflation is more under control. We've got a number of rate cuts priced into the markets over the next 12 months, which has been a big shift from what we'd seen previously in previous years. But we do think the market's got a little bit carried away with some of the optimism. So if we're looking at soft versus hard landing and the kind of economic scenarios, after the Fed cut rates in September, we saw a huge amount of optimism for the soft landing scenario. Now, I'm not saying that we're not in the soft landing camp, but we're interested in the asymmetry of risk in markets, and the hard landing scenario is probably the most underpriced risk in markets at the moment. There was a great survey recently from Bank of America, one of their credit investor surveys, and investment grade investors feel that the hard landing scenario or harder economic recession is the most underpriced risk in markets. So we're definitely not getting carried away with some of the optimism in the market, and we would just encourage a little bit of caution around the economic. So it took a little bit longer than expected to get to this point. Earlier in the year, we were expecting interest rate cuts to feed through a little bit quicker than they have done, but we've got there. The easing cycles have begun, so over 60% of the world's central banks are now in easing mode. Some are a little bit further ahead than others. For example, as I speak, the Bank of Canada have done a few more cuts than I can see in most other markets. And a market like the UK are a little bit further behind. So their central bank policy rate is still at 5%, which looks quite high relative to some of the other markets. So what can we expect going forward? We are expecting policy rates to continue on that downward trajectory in most of the world. Bank of Japan is probably one exception to that. And what we're looking at in terms of what the market's pricing in 1 year's time, in the US, you're pricing in, I would say, about 3.5% in terms of where the policy rate will be in 1 year's time. In Europe, it's a bit lower than that, so it's less than 2%. We think that those terminal rates are probably still a little bit too high. So that's maybe where our view differs to some investors in the market, is that we're quite constructive on duration. We think that growth will probably surprise to the downside at some point, and therefore the terminal rates and the rates that we have in 1 year's time will probably need to move a little bit lower. So we're quite constructive on European duration at the moment. As a result of that, we think there's some room for bond yields, certainly, to compress from where they are today and to rally. And in the US, we think that will come through, but there's a bit of short-term noise, obviously clearly linked to things like the US election and a few other bits and pieces. So the US data has been much stronger. But we are constructive on duration. We do expect yields to continue to come down from where they are today. And we think that easing mode is here to stay. Well, yeah, you're absolutely right. The last couple of years it's going to be the year of the bond. And I think we have started to see some more positive total returns from fixed income, which is great to see. And we think that environment can continue. So the starting point for lots of different bond markets at the moment for yields is much, much higher. So we have very attractive starting yields, which bodes well for total return prospects. But if we think about what do we like, what don't we like, I'm going to break it down into a couple of factors. So the two major risks in any bond portfolio are interest rate risk and credit risk. So I'll give you a view on each one. Interest rate risk, we're very constructive at the moment. In the most immediate short term, there's going to be a bit of volatility for duration assets and rates markets. But in the medium to long term, we do think there's good scope for bond yields to come lower and for there to be a capital uplift in investors' portfolios. For choice across currencies, we do like core euro duration, and we also like US dollar duration, but we probably have a slightly more high conviction view on euro duration, as we think the backdrop in Europe is conducive for lower yields there. So we think bond yields have some good prospect of rallying from where we are today. If I focus now on the second type of risk, credit risk, what do we like, what don't we like? Well, generally we like the higher quality aspect. So you're getting paid pretty well across the curve in different markets. The front end of the curve, we think there's a bit more value, certainly in Europe, maybe slightly less so in the US. In all maturity credit, it's hard to find value in US investment grade just on a spread basis, just because credit spreads are as tight as they've been since 2006. So there it's very difficult to look at that and say that it's screaming lots of value. In high yield, if I look at the high yield market, European high yield again screens are slightly cheaper than US high yield and Asia high yield. So generally in terms of currency, we like Europe, and in terms of quality, we prefer investment grade at this point in time. So we found over the last 12 months, investors have been incredibly defensive, and they've expressed that in two ways. One is that they've gone into kind of cash and money market assets, and two is that they've gone into kind of longer duration, higher interest rate risk, aggregate bond type portfolios. So, global aggregate, US aggregate, these kind of areas, playing for that capital uplift if we see a rally in yields. Now, we do expect certainly the former to change a little bit from here as cash rates start to come down. We think some of the tourist money that's gone into money market assets will probably start to find new homes. So it will start to reach for yield. We think investors will start to look certainly at the front end of the curve. That's where there seems to be a bit of value. That's the natural home for people who are looking for a step beyond cash. And so I think funds like, for example, the Fidelity Fund's Global Short Duration Income Fund could be a key beneficiary of that, just in terms of investor demand and the positive technical that sits behind credit spreads in that part of the market as well. I think longer term, as curves start to normalise and steepen, as in the yields at the longer end of the curve are higher than at the front end, I think that's where investors will start to then look to all maturity credit and corporate bond type strategies. And I think that's where they'll start to move. So I think the first thing is, if we just talk about valuations again, so looking at the spread environment, credit spreads, they are tight, but I think they're tight for a reason, because corporate fundamentals are good and the technical backdrop is good as well. So if you look at some of the default expectations out in the market, Moody's, for example, we're expecting global high yield default rates to go from somewhere like 5% down to below 3%. We're not disagreeing with that. We think that there's good scope for default rates to tick down from where they are currently. But we're more interested probably on where the best kind of risk-adjusted reward is across different rating cohorts. So for us at the moment, we get the most excess spread looking at the higher quality cohorts. There's little margin for error in some of the lower quality parts of the high yield market if we were to see any difference to that default expectation. So if we do see a rise in defaults or even stable defaults from here, you're not getting paid as a credit investor in some of those lower quality parts of the market. So where we can, we are trying to move up in quality, and we would encourage investors to do the same. So if we just take a step back and think about what a fixed income investor is looking for, and I'm going to speak broadly and kind of globally, it's three things. So one is a steady and stable income stream, higher in some parts of the market than others. Two is safety, which can be measured in different ways, so volatility or drawdown. And three is the diversification benefit you get, so the low correlation to equities. Now, those are the three benefits. If we look at the market today, you have got very attractive yields. We think the safety element, bonds seem to be behaving themselves a little bit more, partly because inflation seems to be a little bit more under control. But the correlations have been moving around. So more recently, we have seen more negative correlations between equities and bonds. I'd say that's probably also one of the risks here. If we do move into an environment that we're not expecting, like a high inflation, high growth environment, that's probably not going to be great for the diversification benefit between bonds and equities. However, that's not our base case. And so we do think the diversification benefit for bond investors is going to continue from here.